The topic I will be going over you today is corporate specific deductions and associated book tax differences. Corporations have a very unique tax code, and we will cover some of the major differences between the corporate tax code and the individual tax code. Certain deductions and corresponding limitations apply, specifically to corporations. This is just an introduction to the most common deductions and how they differ in relation to book tax. And then some of the main things we will be going over is how are stock options used as tax deductions, and how are they recorded by books tax, as well as how are they used as incentives to keep employees happy and working for the same company. Also, how are net capital losses recorded as tax deductions, and how are they recorded in book tax? Also, we were going to be going over net operating losses, how they are recorded, and what to do with excess deductions, how to carry them over to previous years or future years, and also what are the limits placed on charitable contributions by made by corporations, and how are these recorded and carried over year to year. All these things are inherently different than, than how they are taxed on the individual tax code. So these are very important to be knowledgeable so you can take advantage of them or set up a corporation to take advantage of them. First, we have stock options, and this will allow for corporations to compensate employees with stocks at a predetermined price over a specified period. Basically, this means that s- companies will require their employees to work for a certain amount of time before you become vested and can buy the stock options that you were offered in part of your employee contract. And after this requisite service period, you can now buy those stocks as long as you pay the exercise price, which will be around the price of the market when the contract is made. So if the price of the stock has gone up since you made your contract, then you'll be paying under market value for the stock, and this is why it can be very favorable for employees to have stock options. Also, if employees quit before the stocks are fully vested, then they forfeit those options that they did not have the requisite service time for. So this is a double-edged sword. It and it encourages the employees to stay until they have their full requisite service time and have all their stock options fully vested. Uh, Also, these options become valuable when the stock price is greater than the excess price, and stock options have become extremely popular as they give employees a vested interest in the company's stock price going up, which intrinsically makes employees work harder, which will in turn drive the stock price up. And how these are taxed, there are two main ways stock options are taxed. They can be classified as ISOs or NQOs. Uh, ISOs or incentive stock options are not deducted as a compensation expense for tax purposes compared to NQOs that have corporations deduct the difference between the fair market value of the stock and the exercise price of the option, also known as the bargain element. This deduction will be exercised when the employee exercises the stock option, in turn buying the stock from the stock company. And for book tax, corporations will estimate the fair value of the options when issued and deduct the value over the requisite service period time. This will create this will create differences as uh, employees won't always exercise their stock options, so it will create imbalances year to year until the employee exercises their stock options or until there is a correcting journal entry. And for ISOs, the book tax is a unfavorable permanent difference, as there is no book deduction, as there is a book deduction, but there is no tax deduction. And also NQOs can create temporary and permanent tax differences as well. And corporations recognize the differences as employee stock options become vested but not exercised. So this is going to happen year over year. There will be differences basically every year if you have a large enough company. And when an employee exercises an NQO will differ from compensation expense on the income statement. And the corporation will have a favorable permanent book tax difference in the amount of the tax deduction exceeding the total book expense for the options. Next, we'll be going over net capital losses, and this is for corporations. All net capital gains are included in taxable income and taxed at the base rate of 21%. Corporations can only deduct capital losses equal to or less than their capital gains. This is why many companies prefer capital gains over ordinary income capital. Corporations are allowed to recognize these net losses up to 3 years in the past and 5 years in the future. If it's in the past, it will be called a net capital loss carryback, and if it's in the future, it will be a net capital loss carryover. These losses are applied in chronological order, so you will first try to apply it 3 years in the past, then 2 years in the past, then 1 year in the past, and then 1 year in the future. So you can't just do it 5 years in the future. You have to do it in chronological. You have to apply the loss in chronological order and then carry it over to the next year in that order. And for reporting purposes, corporations will deduct the net capital loss the year it is incurred, creating an unfavorable book tax difference in the year they incur. And the losses and will have favorable book tax differences in the year they use capital loss carrybacks to offset the net gains. So that's just a key concept that you'll want to memorize in your head. Uh, Capital loss carrybacks create favorable book tax differences, and then uh, capital uh, capital loss carryovers when it goes into the future are going to create unfavorable book tax differences. And next, we'll be going over net operating losses, and this is when deductions are in excess of its income. Corporations may not deduct previous NOL in calculating the current year, and corporations may deduct a carryover against the net gain in the current year in calculating, but won't be able to deduct a capital loss carryback against the net gain in calculating its NWL. So that just means that you can deduct future carryover, but not previous carryback. And corporations can now carry forward NWL occurring in 2018 or later indefinitely and offset up to 80% of taxable income for the NOL deduction in those future years. And then if it's before uh, 2018, then it can be carried forward 20 years and back 2 years and offset 100% of taxable income before the NOL deduction. And corporations will use the FIFO basis in determining which NOL carryover to use. For reporting purposes, corporations report losses the year they are incurred, and corporations will report unfavorable book tax difference in the year they generate these NOLs, Corporations also report favorable book tax difference in the year they deduct the NOL carryover for tax purposes. And this NOL carry forward amounts are reported on the Schedule K, Form 1120. Next is charitable contributions, which will deduct the amount of money contributed, the fair value of capital gain property, or the adjusted basis of property donated. The big difference for corporations is that there is a 10% limit of the charitable contribution deduction that is based on the modified taxable income. And that is going to be the big thing that you will need to know. And the modified taxable income is going to be uh, taxable income before you deduct charitable contributions, dividends received deduction, and capital loss carrybacks. But you will be able to deduct capital loss, and NOL carryovers will be deductible. And with this 10% limit, you will be able to carry over the loss for up to 5 years. And you will be able to always calculate the contribution deduction as the lower of the total contribution, total amount of charitable contributions, or the 10% of the contribution limit modified taxable income. It will be one of the two, and the smaller of the two. Or I mean, and corporations will be allowed to carry forward this contribution basis in excess of the 10%, and will follow the FIFO basis. Uh, in this presentation, I think you've learned that corporations have a very different tax system than the individual. Stock options are very beneficial for corporations as employees become financially invested and tied down to the job for a longer period of time. And capital gains are more valuable than ordinary income for deduction reasons. And due to NWLs, consistent gains are not needed for a successful business. Uh, if you have drastic changes in income and net gains, it is not that big of a deal. Net income is net income due to deductions and carryover laws.